Foreign investors sold an estimated $8 billion in Chinese yuan traded stocks in March alone. The MSCI China Index, of the largest and most liquid Chinese stocks, was down 30% at one point before rallying. It continues to lag its global counterpart. The benchmark CSI 300 index is about 4% above its pre-pandemic level, while the Golden Dragon Index of US-listed China stocks dropped by a quarter.
It's hard to call a bottom in terms of the end to the recent volatility in the Chinese market, but after the large correction that we've already seen, I would say that it does appear that we are closer to the bottom. But that's not to say that the volatility is at the end, because I think we're going to continue to see probably wide swings, both on the upside as well on the downside for the Chinese market. I don't think that's going to be something that's going to be unexpected because of the various risk factors that still remain concerning Chinese equities.
The big sell-off was followed by a strong rally after Beijing said it would support the economy. But even after this rebound, valuations continue to look attractive to some investors.
Just talk about MSCI China, for example. MSCI China is trading at a forward PE of nine times, compared to the broader Asia ex Japan index, which is trading at something like 12 times. And obviously the US market is trading at something like 18 times. So the Chinese market is definitely cheap. But the issue here is one of investment sentiment, whether or not, as I said before, whether they regard the Chinese equity market as being investable.
One of the more undervalued sectors at the moment is certainly pockets within the consumer discretionary space. Some of the companies that we like here, obviously, those that are catered to the consumption story in China. Obviously, COVID is impacting them in the near term, but they are actually names that we think will be relatively shielded from factors such as inflation, from regulatory risk, and from geopolitical risks as well. Other sectors that we think where we expect stronger growth include the biotech space. But the biotech space obviously is a little bit more riskier because you're talking about smaller companies that may not be necessarily profitable at this point in time. So you're talking about the strength of the pipeline of their drugs.
Sounding a note of caution, JP Morgan downgraded 28 Chinese internet stocks, saying that the Chinese market is essentially uninvestable. But others are more upbeat on China's investment prospects in the longer term.
The entire Chinese market is still one that you can't really avoid. You're talking about over 1 billion people, consumers. Some of these companies that we're talking about are in the leading space. They're the leading ones in their respective sectors. And if you look at it from a valuation standpoint, a lot of them are trading at extremely cheap levels. I think in time, if all this comes back again, there is a very good potential for the Chinese market to actually re-rate upwards, which means that investors who've got a middle to long-term kind of time horizon will be rewarded for their patience.
Investors will also have to consider the balance between risk and reward, especially given the ongoing uncertainties that could roil the markets.
Now, number one, developments related to the Russian-Ukraine conflict, its broader second-order implications are related to China's geopolitical positioning and also the effects of higher energy and commodity prices on China's economy. A second, risk related to the slowdown in China's property sector. And importantly, the impact of this on the financial health of property developer and its bond markets. Third, the COVID situation in China and the impact of its recent curbs on its economy as policymakers adapt to the more infectious Omicron strain. And finally, international investor concern as well over the potential delistings of ADRs. So all this could affect near-term sentiment for Chinese equities.
Experts say investors could also consider alternative options to buy into China's future growth without being too exposed to the Chinese markets.
One of the names I do like are the industrial robotic makers who are primarily Japanese companies, but whose growth is really stems from basically the demographics in China, which means that more factories are actually going to be using industrial robots to improve their efficiency and their productivity levels.
I think what's interesting in markets relates to a saying that when others are fearful, it is time to be greedy, and vice versa, when others are greedy, it is time to be fearful. And this relates to the idea that usually when sentiments are very downtrodden, that's when value tends to emerge. And that's very often when we see the potential for greatest returns over the long run. And in conclusion, I will advocate for investors to, again, stick to their long-term investment strategy. Emerging market equities will tend to exhibit higher volatility and market beta, but I think a long-term focused strategy that is well diversified will yield acceptable fruits